So far this year, the Russell 2000 Value Index is running neck and neck with its growth counterpart. Our next guest may be a value investor, but says he's looking for investment opportunities in some traditional growth sectors. Peter Thompson is the CEO of Perkins Capital Management, which has about $20 billion in assets under management, and he's joining us now to talk about investing in the current environment, which, as we've seen more recently, can be a bit tricky with all the volatility we've seen, but you're a long-term guy, I know. So, over the past several years, growth has outperformed value. But what are you looking at now in terms of why value might start to do a little bit better?
Sure. I think, there's some fragile optimism in the market right now. I think investors are optimistic because a couple of years of strong stock market returns. There are some compelling economic data, real hard numbers that's cause for optimism. But there's also a great fragility in the market. There's a little bit of selective memory. 2008 seems like ancient history to some. And so I think that the desire to invest in a value manager, somebody who protects on the downside, really a bedrock type holding is exciting for people these days and interesting.
I'm curious, when you look at things overall right now and you see the back and forth we've had with oil prices and the effect that's had on the market, how concerned are you for the fundamental picture?
Sure. In our case, the way we invest, one of the first things we do is try to quantify the downside price of a stock. And so it's a little bit unique, it's a little bit different. Rather than focusing on the upside or where a stock can run, we really look at things from...
You look at the worst scenario and how far down could it fall as a result of that scenario.
Pretty much. It's a humble approach. I think, starting out with thinking how wrong you can be. And so when there is uncertainty in the market, and certainly there's tons of uncertainty in oil, who'd have thunk that Libya, Tunisia, Bahrain, all this would have unfolded. So where there's uncertainty, we'll just kind of move on and look at places where we think we can quantify the downside a little bit more.
Peter, talk to me about where you're seeing some of the opportunities.
Sure. Our company tagline is uncommon value, and we like to say we go to where the value is when we invest, and we don't subscribe to any kind of preconceived labels as to which sectors should be value sectors or which should be growth sectors. Again, we look at the numbers, and if the value makes sense to us, we'll enter a position. And so currently we're actually looking at two sectors which have been more traditionally growth sectors, specifically technology and healthcare.
Well, let's start with technology, because obviously, it's interesting to be looking at a tech investment right now at a time when, we've heard some murmurings from Silicon Valley about another potential bubble out there, and yet you're a value guy.
Right.
So you're definitely not looking at stuff that's expensive, presumably.
We're definitely not looking at things expensive, and as you know and can imagine, these stocks that we're looking at now are the stocks that were light years off our radar screen 10 or 12 years ago. These were stocks that were trading at multiples that were just unfathomable. But when you look at some of them today, particularly the larger cap technology stocks, they're trading at below market multiples. Many of them have really cleaned up their balance sheets. They have no debt. They're flush with cash. And that allows us to feel good on both the upside, kind of looking at the opportunity for the stock, but almost more importantly on the downside. As I said earlier, we really do focus on protecting assets during the difficult periods. And so those companies we think are really prepared to weather the storm.
So you're looking at some of the large cap, I don't know if specifically investing in, say, a Microsoft or a Cisco, but we have had some more disappointing reports coming out of some of these guys recently, and they're being overtaken by some of their younger competitors like a Google or an Apple. So you would be looking more on the older technology company front, perhaps.
Young or old really doesn't make a difference. The price is what makes the difference, and so where the value is, we will invest.
All right, so let's talk about the other area that you were talking about, healthcare. How do you get any clarity in this business when you don't really have a good handle on what the regulation's going to be? Right.
It's difficult, but I think the companies are figuring that out. I think the companies are getting a better sense of what the new world is going to look like for them in this post-healthcare reform environment. And so I think they have a sense of how they're going to get paid, how volumes can increase. We focus a little bit more on the medical devices, lab testing equipment, things like that really will benefit from preventative care types of measures, and especially from a volume perspective.
But at the same time, aren't those guys going to be hit as funding gets cut for Medicaid, for example, because those devices are expensive in many cases?
Sure. In some cases the margins will be affected, but if you look at the offset to that margin, the volume, and then the predictability of payment, we think more than offsets that.
I'm curious if there's any areas that you're staying away from.
Well, typically we do stay away from utilities, which is, again, a little bit uncommon for a value manager. Many value managers have portfolios that are loaded with utilities. But as I mentioned earlier, balance sheet investing is really what we do. And so the amount of debt that many of those companies carry on their balance sheet, the amount of regulation that they're subjected to, really doesn't make them candidates for the way we invest.
And then also, you're sort of staying away from financials to some extent. Which is interesting because you've seen some investors come back and sort of selectively to the financials.
We do have some exposure to financials. We're underweight versus maybe our relative benchmarks, but from an absolute perspective, it's a big portion of our portfolio. We like insurers. There are some insurance companies, property casualty insurers that we've been investing in. Certainly the money management business, the investment management business, our own. We think we understand that quite well. We think there's some unique opportunities there as well.
And I'm just curious, just quickly to sort of wrap it up, when we started out by looking at the Russell growth versus the Russell value, and growth, again, has outperformed value over the past year. What do you see happening? Do you see the economic cycle sort of pushing value to outperform by the end of the year?
Well, I always think that it's best to buy things when they're on sale. So I think that over time, over long periods of time, value has proven to outperform growth. And we think that now is as good a time as any, especially when you're coming back into the market on the heels of a difficult period only 2 years ago, and you're looking for a bedrock type investor. Value investing is where to go.
All right, Peter Thompson, head of Perkins Investment Management, thanks so much for coming in to talk to us.
Thank you.
Appreciate it.